Hi, and welcome to the Interaxis YouTube channel on Interaxis.io. We've been talking quite a bit about risk and looking at some of the technical aspects and the financial aspects of risk, both in the traditional world and in the decentralized world. And today we're going to talk about something that was created by Consensus. It's called DeFi Score, and you can look at it at DeFiScore.io. They have their white paper, they have their GitHub, they have access to their Telegram group, and you can read all about this. And so I'm going to talk a little bit about DeFi Score. What DeFi Score aims to do, and it's one of the first attempts at this, is what they're looking at is especially some of the lending pools. So you look at lending pools like Compound, Maker, what else? I think Torque might be in there. DYDX is in there. Okay, what we're doing is we're looking at especially some of these lending pools. These are all smart contract driven lending pools, and they're trying to assign some value of risk to this. And what they're trying to do is for me and for you and whomever might be putting their money into decentralized finance, into some of these lending pools and trying to earn some interest, and maybe those of us even that are trying to borrow against our cryptocurrency in the decentralized lending pools, what they're trying to do is identify what the risk might be for me to lose some or all of my funds there. Right, and they're trying to quantify it, give it a 0 to 10 number by looking at multiple different aspects and rating each one of those aspects, and when you add it up at the end, you get a number from 0 to 10, and that's kind of a start with how we're going to rate these, in particular these lending pools. Now, eventually, it might go into decentralized exchanges. It might go into things like SET protocol, the online fund management type tokens, or online fund management abilities. Online fund management companies. So they're trying to take this idea of scoring or rating and adapt it there. Do we have scoring or rating in the traditional world? Of course we do. We have a huge company, Morningstar, that gives all sorts of ratings for different types of mutual funds and ETFs and such. You have S&P, Standard & Poor's, that gives ratings to bonds and funds. Moody's, AM Best, they rate all sorts of things. They rate insurance companies, they rate funds, they rate bonds, they rate bond funds. They might go AAA, A plus, B minus, all those kinds of things. And so we have all these different ratings agencies, and they kind of publish, here's how we go about rating them. Here's our framework, here's our methodology to rating, and they go out and rate all these different financial companies or funds, so that I, as the investor, have some potentially independent third party that's rated these, and I can go, oh, I'm okay investing in a AA rated fund or a four-star rated Morningstar fund because I feel pretty comfortable with the management of that fund, or I feel pretty comfortable with how they've performed, or what their methodology is for choosing the equities or the bonds they're going to invest in. That's really important for me personally. It's also really important for organizations like institutions, pension funds, endowments that might want to invest in bonds or bond funds, that might want to invest in ETFs or mutual funds or hedge funds or insurance companies even. It's really important for them because they, according to their investment policy statement, right, all those, endowments, and we'll go into this in another video, but the endowments, the pensions, the other institutions, they have what's called an investment policy statement. And their investment policy statement is kind of what dictates what they are allowed to invest in and what they are not allowed to invest in, right? So pensions might say, look, we can't invest in bonds that are lower than AA rated or lower than A plus rated. And once a bond by Moody's or S&P or AM Best or something gets downgraded below that, this pension has to get rid of that bond, take it off their books, and go find something else to purchase. If they've invested in some sort of mutual fund or ETF or insurance company or something, and that gets downgraded, they might have to get rid of that investment and buy another. Well, of course, if it gets downgraded and huge institutions and pensions and endowments have to get rid of a certain bond or a certain bond fund, that means the price is probably going to go down because there's going to be a whole lot of selling of that particular fund. So I, as an individual investor, want to know what the ratings are. You, as an individual investor, probably want to know what the ratings are for any sort of traditional investment, if there is a ratings available for them. A lot of private investment don't have ratings available. But you want to know what the ratings are and how that methodology, potentially how that methodology is reached. Now, sometimes we've gotten to the point where we have given so much trust up to Moody's and S&P and AM Best and Morningstar and everything that we just say, look, we kind of trust you, and we're going to look at your star rating or your AAA rating or AA rating or whatever, and we're just going to accept it as it is. We have to be careful about that, because if we go too far down that path, we give those companies a whole lot of power to really dictate what's going on with funds and even with the economy. And we don't have to look too far back. We can look back about 10, 11 years to the mortgage crisis and realize that a lot of mortgage bonds, bond funds, collateralized debt obligations and everything were extremely highly rated by S&P, even though the underlying assets there were absolutely horrible. So we have to be careful putting too much trust in some sort of centralized authority to rate things. That being said, the nice thing is Consensus has given this DeFi score, but they have the opportunity for us to go on GitHub and have discussions about it and identify what else should be in this score, should be in this rating. So when I'm identifying, do I want to put some of my money into Compound or Maker or DYDX, I can maybe look at the score and go, okay, I understand how that scoring is reached, and I feel comfortable or I don't feel comfortable placing my money there. Now, the scoring they have to do is much different, of course, than the scoring for a bond fund or an ETF or a mutual fund, right? The scoring they have to do is very technical right now, because everything we're talking about, all these are very decentralized smart contracts. So if we'll recall, I'm going to erase a little bit, if we recall, the whole idea of these lending pools, and you can go back to the videos on the lending pools and then maybe go back to the videos on the associated risk, but the idea is for something like Compound, right, is I might put in my, I might want to lend money, so I might lend DAI into this Compound pool, right? Here's the pool, which is a smart contract, right? This is one huge smart contract for lending DAI. So I lend DAI, or I make a deposit of DAI into this pool, and someone else is potentially borrowing DAI from the pool. All right, I am providing liquidity to the pool. This is providing demand. Okay, in here is some algorithm that determines, based on whatever amount of DAI is being put into the pool and whatever amount is trying to be borrowed, there is some sort of interest rate that these people are going to pay to borrow, and some sort of interest rate I'm going to receive in order to deposit money into the pool. Okay, I am providing liquidity, they are providing demand. They also have to provide collateral, right? And the collateral is usually something like ETH or something like that. And in this case, this has to be 150% collateralized. I believe that's a number at a minimum, meaning if ETH is worth, we'll call it, let's say ETH is worth $150 to make the math easy, I can borrow 100 DAI. Okay, and if ETH gets below this my position might get liquidated, right? And I get my ETH back, and I have to pay back the DAI that I had borrowed. Okay, so it's over collateralized, and it's over collateralized, well over collateralized, because of the volatility of cryptocurrency. Because cryptocurrency can, as we've all seen, can drop 10-20% in a day or a week or so. And you can't have the risk of running out of this pool for all these people that have contributed. That's the beauty of the smart contract. That's the beauty of decentralized finance, is you can control all this with code. Well, in order to control it all with code, we have to over-collateralize for the time being. We don't have, we really don't have the ability very much right now to offer non-collateralized loans in the decentralized finance space. Any non-collateralized loans in the traditional finance space are essentially credit card loans, right? Credit card loans essentially have no collateral behind them. I'm issued a credit card from a bank, and they say, Adam, you have a credit limit of $10,000, let's say. You can spend up to that based on your credit history and your income and everything else. We trust that you're just going to keep repaying it. We're going to charge you a pretty ridiculously high interest rate if you don't repay the whole thing. And if at any time you cannot make your minimum payment or you can't make your payments, we're going to find a way to collect. And if you're late on your payments, we're going to affect your credit report, your credit score, your FICO credit score, which is going to inhibit your ability to get any other sort of loans, right? That's the kind of collateral. That's the credit I'm putting up when I get a credit card, is I can have my FICO score, my credit score, reduced. We don't have that yet in the decentralized world. What we do have is over-collateralized loans. So DYDX, it might be 115%. This is 150%. I have to put up a lot more collateral than the amount I'm borrowing, because the value of ETH might drop really quickly, in which case they will liquidate my loan, give me back my ETH, which is worth less now than it was. And the whole point being that you can't have all these people that have contributed liquidity not be able to get their money back, right? Because again, this is a smart contract. There's no 800 number I can call at Compound and say, hey, where's my money? I want my money back. I can take my money out at any time, 24/7. I just hit a button, and within a few minutes, the transaction clears on the Ethereum blockchain, and bam, my money's back in my wallet. Okay, so that's a kind of a recap of how these lending pools work. So with that, we're going to go into how Consensus has decided, using this DeFi score, to kind of score some of these. So the number one issue we have, the number one risk that we have, is actually smart contract risk. And we talked a little bit about that in one of our videos on risk, right? Smart contract risk. That is the risk that the code in the smart contract is either able to be hacked, there's flaws in it, something like that. So you have smart contract risk. So they have put, of 100% of the total value, DeFi Score has put 50% of their number, of their risk management, or their risk number, into the smart contract risk, right? Now, some of that is going to be code security, right? So they're going to look at things like, has this code been audited? There are firms that will, independent third parties, that will go look through the code and try to determine, are there any hacking risks? Are there any flaws? Is there something someone can exploit? We're trying to avoid the DAO hack. It's not really a hack. The DAO flaw that caused, a third of the money in the original DAO to flow out. So you have, has it been audited by a third party? Has it been verified? Meaning, not only has it been audited, but has it been verified formally? I mean, basically, they're putting their stamp of approval on it and saying this code is really, really good. And is there a bounty program? Right? And the bounty program basically says, for some of these smart contracts, is they put out a bounty, and they basically say, look, if you can find some sort of flaw in our code, we'll pay you. We'll pay you to go find it. Because a big part of cryptocurrency and decentralized finance and everything is the incentive structure. We're trying to give more incentive for people to act in a positive way than in a negative way, right? And to act in a positive way, we say, look, we'll actually pay you if you find some sort of flaw. And that way people are trying to find flaws to get paid, not trying to find flaws so that they can exploit them, right? So part of the 50% is code security, right? And all these are adding up to, I believe it was 35% total I apologize, I'm looking at my notes. I don't usually do this, but I want to make sure I get this right. Another part of the smart contract risk is the code openness. Okay, and code openness basically says, have you allowed us to view your code, but not only the actual code, the actual smart contract code, but this also involves things like oracles, right? Because if the oracle, if whatever drives the liquidity or the collateral or the code or whatever, if whatever that oracle is that drives the smart contract actually execute something, like something like closing out my position, right? If these oracles are not on chain, meaning they're not transparent, they're not immutable, all those things that we like about decentralized finance, if this is some private oracle or off-chain oracle, then you've taken a lot of the security that's built into decentralized finance, the security that's built into either the proof of stake or proof of work networks that we've built so hard, that we've worked so hard to build, and you're taking it and you're putting it in the hands of a private database or an off-chain database or something that we can't control quite as much, or we can't view quite as much. We don't have as much visibility into. So if too much of the oracles are off-chain or private, then that actually decreases the score a bit, right? So this is another, what is this, 15%. Actually, I think this is 25, and this is a total of 25%. So the two of these make up about half of the DeFi score. So you have smart contract risk, which is a big one. Have you audited the code? Are there flaws in it? Can we verify that we don't think there are any flaws in it? Has some third party done that? Is there a bounty program? Are you openly saying, hey, if you find a flaw in our code, we'll pay you for it? And then the code openness. Are you relying on too many oracles or private data or off-chain data? Is there code that we can't even see? You're hiding it for some reason or another, and not that you're doing anything malicious, but we can't verify it quite as well. It's just like if you had a mutual fund and you told Morningstar, look, we're not going to tell you everything we're investing in. Morningstar would go, well, then we can't give you a very good rating because we just don't know. We just don't know what you're invested in. If you're invested in your brother-in-law's company, we don't know anything about it. So if you won't open up your books, we can't really rate you. It's the same thing. If you put too much of your code in a place that we can't see it, or you rely too much on code or databases or something that we can't really verify, then it's really hard for us to give you a really high score in the decentralized world. Okay? So again, 50% is smart contract risk. All right. Then we get into, as we've discussed before, you just have the financial risk. Right, and this is 35% of the scoring. So what is financial risk? Financial risk looks at things like the collateral. As I said before, Compound has a 150% collateralization ratio, and usually the collateral that you use is ETH, right? So I keep using Compound because I think Compound is their highest rated on the DeFi score. It might be Maker. I don't really remember at the time, and I'll have to get that data. But the last I looked, I think it was Compound. But 150% collateralization ratio, a lot of it is ETH. Now, that kind of makes for a higher score here. And the reason is because 150% collateralization ratio means that if the price of ETH drops, again, in my example, if I put up if ETH is worth $150 and I put up 1 ETH and I get $100 back and the price of ETH goes to 125, it liquidates, right? I get my ETH back. My DAI gets repaid into the pool, okay? But there was plenty of ETH to liquidate to do that. There's still 25% above the amount of DAI, right? So there's plenty of collateralization there. Also, ETH is compared to most other cryptocurrencies, is very liquid, right? Probably The only crypto that's more liquid than that is Bitcoin, right? So ETH is very liquid, and therefore this gets a high score for collateralization. If you have a lot, if you can look inside the smart contract and see a lot of the collateral is ETH, and the collateralization ratio is 150%. If this were some small cryptocurrency that had very low liquidity to it and was extremely volatile because of that, and this collateralization ratio was only like 110%, this score would be really low. So what they're looking at again is the safety and security, right? If I put my money into the pool, how confident am I that when I want to take my money out, it's all going to be there, right? And this lends to that, because as soon as the value of my collateral gets below 150%, it's going to liquidate, and it can liquidate pretty easily because ETH is an extremely liquid cryptocurrency, and believe it or not, is relatively non-volatile compared to a lot of the other cryptocurrencies. Because there's so much liquidity to it, it doesn't jump up and down quite as much as the other cryptos, therefore high scores for collateral, right? Another thing we look for, as I've said, is liquidity. So as people are putting DAI or money into this pool here, and others are borrowing and contributing ETH as collateral, right? What you're looking at is how much liquidity is there. If there's only 100,000 DAI in this pool, and I've contributed 5,000 of those, let's say, there's not a whole lot of liquidity. It's not going to take a whole lot for everyone to pull their money out, and this smart contract isn't very effective because it kind of needs a lot of DAI and a lot of ETH and everything else in here to make the algorithm run correctly, right? There's kind of this law of large numbers that says you have to do that to make the algorithm run correctly to be safe. If there's very little DAI in here, this algorithm is going to be making this interest rate go all up and down. It's going to be potentially making the collateralization go all funky and up and down, and my interest rate might jump from 2% to 12% and back again. That means people are going to be pulling their money in and out all the time, right? So the more money that goes into this pool, the more liquidity that's going in, the higher the rating for this liquidity number in terms of the DeFi score. That's really important because I want to put my money where potentially more people are putting their money. It's going to actually make it a whole lot safer, right? Into the smart contract where more people are putting their money. It's safer for me because at any point, if I want to pull my money out, it's going to be there, right? That's part of the liquidity score. So the last part of the score, so that's let's see, 50%, 35%. So my math says that other is responsible for 15%. And other is things like, is there insurance available? All right, insurance is very new in this space. You have Nexus Mutual, which I talked about in a previous video, which is really the only one that's insuring smart contracts right now. Others are kind of building systems around that, but right now Nexus Mutual is the only one. So is there insurance available? And then they're looking at regulation, right? Is there a chance that at some point regulators, whether it's in the US or any other countries, look at this smart contract and go, you know what, that's a security or something like that, you got to get rid of it altogether. And all of a sudden, either my funds are locked up because the SEC or whomever has said, you have to lock all that up, we got to take a look at this, or they say you just have to get rid of it and it all gets wiped away, or they look at ETH and they go, hey, ETH is a security, it can't move anymore, and all of a sudden that locks up the collateral or that decollateralizes the entire pool, something like that. So they look at regulations and how regulations will eventually affect the smart contract or the lending pool. So again, you have smart contract risk at about half of it, because again, we're outsourcing so much to code that we really have to look at the code as 50% of the potential risk right now. The financial risk, 35%. So then we look at what's actually happening within that pool, and we say, okay, how much collateral is there? How much liquidity is there? Would I feel comfortable putting my money in? right? And the last is other things like insurance regulation, and that, of course, adds up to 100%, and you get a score of 0 to 10, and you can kind of measure. Now, the great part is, as this ecosystem is growing so fast, there's the ability to, again, go to DeFiScore.io, to their GitHub page, and actually at their Telegram group, and actually contribute and say, look, here's how I think the scoring should be. Here's what I think should be added or subtracted from the scoring. They're also, again, going to look at how can we do some sort of scoring for things like SET protocol, Uniswap, decentralized exchanges, other sort of decentralized protocols. They'll probably do some scoring for decentralized insurance when there's more of it. There'll be all sorts of scoring because we're going to have to mirror in the decentralized world what happens in the traditional world. And in the traditional world, there's ratings for bonds and stocks and funds and bond funds and ETFs, and there's ratings for insurance carriers and everything else. Like I wouldn't buy insurance from a really poorly rated insurance carrier, because I'm worried that carrier might go out of business. And if that carrier goes out of business, then all the premiums I paid for that insurance might just be gone, and I'm never going to get to collect on that. So it's the same thing. We're going to have to start rating these companies. We're going to have to figure out all new rating systems, somewhat based on the traditional models, but somewhat based on the new decentralized models, because we have to be able to score. We have to be able to understand where we're putting our money in and what we're putting at risk. DeFi Score is really a very good first iteration of that, and they're allowing us, those of us that are involved in the space, to go and kind of help them drive this. So I wanted to talk because I've talked about oracles and smart contracts and all that. So I wanted and risk. So I wanted to go and talk about DeFi Score as something maybe we should take a look at and people should get involved in and try to get involved in the conversation and try to drive it in a certain way, and maybe look at how would I look at some sort of scoring for portfolio management or fund management in the decentralized world. How would I look at scoring for insurance in the decentralized world, and kind of help guide the conversation, because in the absence of that, someone else is going to create the score, right? So you might as well be there and help actually create the scoring methodology, create the ratings methodology that we're going to use in the future. So I hope you liked the video. I hope you subscribe to the YouTube channel and you're enjoying these. Our website, interaxis.io, Twitter @interaxis8, the number 8. Please let us know if there's any other videos you want to do. Please let us know if you have any needs for your company or your organization, for any sort of training, any sort of customized videos or education. We're happy to do so, and we'll see you at the next video.